We will now begin with panel discussion on direct taxes.
With direct taxes, every citizen has a stake in the success of our economy, contributing their fair share and thus reaping the benefits of growth and opportunity.
Understanding the provisions of taxation is no easy task, and that too, to practically deal with the taxation of various entities is an uphill task. To shed light on the several taxation issues, which we have an amazing group of panelists with us today, ready to share their knowledge on direct taxes and clarify all their doubts on this. This session is presented to us by Singhvi Dev and Unni.
Let us welcome the speakers onto the dais. I request CA Ganesh Shandage to escort our moderator CA Abhishek Goenka onto the dais.
A huge round of applause to our moderator CA Abhishek Goenka. CA Naveen Hegde to escort CAH Padamchand Khincha onto the dais, please. A huge round of applause to CA Padamchand Khincha.
I request CA Nagarjuna to escort our second panelist CA.P. Srinivasan onto the dais.
And I also request CA Varun Gore to escort our next panelist, Advocate CA Chythanya onto the dais, please. A huge round of applause to our moderator and panelists on the dais.
To give a brief introduction of the speakers on the stage, Abhishek Goenka is the founder and partner at KSCAA Advisors, a boutique tax and regulatory advisory firm. Abhishek has close to 3 decades of experience in the advisory field, having been in Anderson, EY, BMR Advisors and PwC. While in PwC, he was the India leader for corporate and international tax. Abhishek is known for his domain expertise in real estate and prop tech. With this brief introduction, we welcome you to the session, sir.
C.H. Padamchand Khincha is a partner in H.C. Khincha & Co. and H.C. Khincha & Associations, Bangalore. With over 30 years of experience in corporate and international tax regime, he has spearheaded the income tax consultancy and litigation practice. C.A. Padamchand Khincha is a prolific writer on various topics in income tax. He has delivered more than 500 lectures across the nation on several income tax issues. He was instrumental in making a critical analysis of the direct tax code.
And next we have CA.P. Srinivasan. He worked for 18 years as head of corporate tax in Wipro Limited, Bangalore. Over 35 years of hands-on experience in industry with regard to corporate tax compliance across the tax jurisdiction. And he also participated as a member of Emerging Issues Task Force on Non-Resident Taxation found by Ministry of Finance. And he also nominated on expert panel of the working group on transfer pricing. Welcome you, sir.
Our next panelist is Advocate K.K. Chythanya. He finished his articleship from PricewaterhouseCoopers, Bangalore and industrial training from Hindustan Liver Limited and practiced as a CA for 14 years, specializing in taxation matters, and then as an advocate for 17 years in various High Courts and Supreme Court, and is now designated as a senior advocate by Karnataka High Court on 14 December 2021. He has lectured and presented papers in various forums and also authored and co-authored various books. With this, we welcome you to the session, sir.
CA Abhishek Goenka, sir, who is going to moderate us. So we have 1 hour with us to hear you all and to clarify all your doubts later. Over to you, sir.
Good evening. Thank you very much. couple of observations in lighter vein. I think it's good that I've been kept away from the three stalwarts because it's very difficult to match their caliber. And when you were reading out their profiles, I was just thinking to myself, the profiles do no justice. I won't even say little justice. The profiles do no justice to these three gentlemen who have shaped the careers of many of us in the room, and I think will continue to guide and inspire us. So thank you, gentlemen, once again for joining us this evening. Just as a format for the audience, we have 9 topics on which we will ask the panelists questions. If possible and subject to logistical efficiency, we will open it up for any questions from the audience. And we have picked topics which we believe are relevant in today's context and which are somewhat related to some of the more recent amendments in the Act. Of course, given that we have only 1 hour, we are not able to cover every single topic, so we will try and make it as interactive as possible. PVS sir, if I can just start with you, and if we can get on to section 139(8) capital A, which is relating to the filing of updated returns. I used to jokingly say that that is almost like a permanent Kar Vidhan Samvidhan scheme, like a permanent amnesty. Sir, I just wanted to touch upon section 139(8) capital A, saying that if there is a foreign company which has had income which it has considered as not being liable to tax in India by relying on the provisions of the applicable tax treaty, hence it has not filed a return in India either under section 139(1) nor under section 139(4). Will such a taxpayer be eligible to file an updated return under 139(8) capital A as a first return to mitigate any possible penalty and prosecution that may arise for any reason if in the future it is determined that its income was indeed taxable under the Act?
The question is, a foreign company has not filed its return under 139(1) or it has not filed a return under 139(4). Now it wants to consider filing an updated return under 139(8)(a), paying the additional tax or whatever is applicable to it. The normal law is that every company or a firm is required to file a return. So there is a mandate by law under 139(1) that every company shall file, whether it has taxable income or it does not have a taxable income, there is a mandate to file a return. The proviso under 139(1) also mandates that a company or a firm shall file a return before the due date for filing the return. The only exception the law makes is under 115(a), where if the company has an income in the nature of dividend, interest, fees for technical services or royalties, then an exemption is provided 2 conditions are met. There is a withholding tax which has been done on the amount of payment they have received or the income which they have received, and the rate at which the tax is applied is not less than the rate which is prescribed in the Act. That is, in respect of dividend and interest, it is 20%. In terms of fees for royalties, fees for technical services and royalty, it is 10%. If these conditions are not met, then a company is required to file a tax. It cannot possibly take a position that it doesn't have a taxable income in India. Assuming that it has taken a position that it doesn't have a taxable income in India, then there is a violation in terms of filing the return at least. So even a nil return is required to be filed under law. Is there a current mandate? This company, since it has omitted to file, I presume it's not a case which is falling under 115(a). This company should have filed the return on 139(1). It has failed. It has also failed under 139(4). But fortunately for the company, 139(8)(a) provides an opportunity to file a return called the updated return, which will have one of the reasons to be ticked for which it is filing the return. And if those reasons are ticked, it can file a return. Even though it may consider that it doesn't have an income, still it may go ahead and file a return, declare an income, pay the taxes, and consequently have a little amount of protection on that. having complied with it, two issues will come. Whether the foreign company is still liable to penalty and whether the foreign company is still liable to prosecution under 276C. Under 270A, the penalty will come for underreported income. Non-filing of a return is also an event for underreported income, and therefore technically penalty is attracted. Likewise, a prosecution is attracted for not filing a income because income which is chargeable to tax, there is no disclosure, and therefore prosecution is also liable. There are no protections given under the Act straight away for these two violations. But one may infer from the construct of the sections that 270A gives immunity, 270AA gives an immunity in certain circumstances. It says that if you have paid the taxes and also you choose not to file an appeal, then you will be given an immunity. That if you have paid the taxes in respect of an assessment under 143(3) or an assessment pursuant to notice under 148 under 147, in these two circumstances, certain immunities are provided. These are not the situations which are currently met. You are not been subject to assessment, you have paid taxes on their own. One can only say that in pure technical interpretation of the law, 270A may apply or should apply, or 276C also should apply. One can only hope that since I have complied with the provision of law as provided in the Act, I should not be subject to these kind of penal consequences, and the protection should be available based on substantial construct that since there is a protection available even for assessed income, not to levy a penalty. Here is a case I have not been even assessed. I come voluntarily, I have disclosed the income as an updated income, and therefore a penalty should not lie and a prosecution should not be initiated, should be the basis on which the contention should be made. So I presume this would answer the question which you have raised it.
Mr. Khincha or Mr. Chythanya, anything to add on section 139(8)(a), sir? Would you like to add anything to this topic?
If my answer is incorrect also, you can add.
Right, sir. Thank you so much, PVS. Mr. Chythanya, sir, I'll come to you. Yes, sir. I'll cover the topic of GAR, which I think is not that new, but still very, very vexed and almost impossible to understand for most practitioners. 3 questions, sir. Maybe I'll start with the first one. Can the income tax authorities invoke GAR to tax notional income arising out of any transaction? So can GAR be invoked to tax notional income?
Thank you, Abhishek. The question is whether GAR can be invoked to tax notional income. It is necessary to understand that GAR doesn't supplement the basic charge. It doesn't create a charge. There is already a charge, and the GAR would come in to circumvent attempts to avoid the charge. The question is whether GAR can be invoked to tax notional income. The answer to that would depend on whether the Income Tax Act provides for tax on notional income. By rule, income tax does not provide for tax on notional income. There are some exceptions. It could be a case of section 92, where arm's length pricing would be done, which would mean a certain income which has not accrued to you or arisen to you could be brought to tax. In that sense, it is notional. Take a case of section 50C, where the difference between the stamp duty value and the actual consideration, though not actually received by you, would be deemed to be part of your full value consideration. You will have to pay the tax. Wherever the Income Tax Act specifically provides for tax on notional income, if GAR is successfully invoked and as part of determination of consequences in relation to tax under section 98, they could carry out the same insofar as the Act permits. it would not permit them to go beyond the mandate of the Act. If you look at the GAR chapter, which is called General Anti-Avoidance Rule, Chapter 10A, that comes right after Chapter 10, Provisions for Avoidance of Tax. If you look at Section 95, which is one of the pillar sections of the GAR, it says an arrangement may be regarded as an impermissible avoidance arrangement and the consequences in relation to tax may be determined. So essentially, the purpose of invoking GAR is to determine the tax consequences. An arrangement to become an impermissible avoidance arrangement will have to have its main purpose as obtaining the tax benefit. Here again, there has to be something called tax benefit, which is defined in section 102 within brackets 10, which will mention the tax benefit as including your avoidance, deferral of tax, or increase of refund, or increase in loss or decrease in income. However, if you would go to Rule 10U, Sub-Rule 3, Clause 4, it will restrict the tax benefit only to the tax effect. So when you make an overall reading of it, it would suggest that the GAR would not permit you to, rather the GAR under GAR, it's not possible to levy tax on notional income except where the, as I've said earlier, Income Tax Act itself provides for tax on notional income. And just to look at the type of tax consequences that could be determined, if you look at section 98 within brackets 1, if GAR is invoked successfully, tax consequences would include denial of tax benefit, denial of treaty benefit, or determination of tax consequences as he considers appropriate. Here again, as he considers appropriate will have to be understood with the preceding word tax. That means there has to be provision in the Income Tax Act. Now let's look at various other actions which you could take under subsection 1. 1 to G if you look at. More particularly, if you look at the clause E to subsection 1 of 98, it talks about reallocation. It doesn't deal with generation or creation of an accrual. An income that has already accrued, that has already arisen, could be redistributed or reallocated. Similarly, if you look at section 98, subsection 2, it would permit debt to be treated as equity or vice versa, or a capital item to be treated as revenue item or vice versa, but it predicates that there is an income, there is a receipt. So, understood thus, as I've said earlier, unless and until the Income Tax Act itself provides for levy of tax on so-called notional income, that too by exception, GAR would not permit the assessing officer to levy tax on notional income.
Thank you, sir. PVS, sir, anything to add on this topic of notional income?
A notional income, per se, the Act does not seek to tax. There is a Supreme Court ruling in Excel Industries which says that notional or hypothetical income cannot be subject to tax. Going by the ruling, I would presume that GAR also cannot be invoked for a tax benefit arising out of a notional income. But what is notional income can be a matter of very interesting. For example, I will give you, I understand there's one GAR ruling on bonus share stripping already. It may not be in public domain, but I understand one ruling has been issued on that. If bonus share, I have not earned that income. Actually, I have lost because I have got the bonus shares, I have sold original shares, and I have lost some income. Whether that loss can be allowed, not allowed, set off. In a way, out of what is that notional income here? Technically, I would say, out of the loss transaction, something is ignored and an income is computed, and therefore the bonus stripping effect is allowed. I would possibly think that what is hypothetical income may be more important than whether hypothetical income can be taxed at all. Because GAR is always about a sphere on a tax benefit which avoided income. If the avoided income is a notional income or real income, will be a matter of extreme debate effect.
Right, sir. Thank you, sir. Chythanya, just coming back to you and one more question around GAR. You know, the guidance given by the CBDT is that any shares which are acquired prior to April 1, 2017 will not suffer the consequences of GAR. Now, what happens if somebody holds such shares which were acquired on or before, not on, but before April 1, 2017, but subsequently that company goes for a scheme of arrangement and the resulting company issues fresh shares after April 1, 2017. All other provisions of the Act treat it as an exempt transfer, but can the mischief of GAR now start applying to those resultant shares?
Yeah, this is a very important question. That's about grandfathering of investments if GAR is invoked. We have to answer this question firstly on the premise that GAR is successfully invoked. So your arrangement is called impermissible avoidance arrangement. Now the question is, would you get the benefit of grandfathering? If you look at section 95(2), GAR would apply for assessment year 18-19 onwards. However, section 101 provides that the GAR will have to be implemented in accordance with the guidelines and the procedure as may be prescribed. So you have a set of rules which will deal with, how the GAR will have to be invoked and what is the protocol to be followed for the GAR to be invoked and what are the threshold exemptions. One of such exemptions is the tax benefit in any particular year for all the connected parties should not cross 3 crores. Now there is one rule that is 10U subrule 1 clause D provides for grandfathering of income from transfer of investments made before 1/4/2017. You have to be carefully here. Income from transfer of investments made before 1/4/2017. That is grandfather. It's only income from transfer, not the passive income. In as much as investments may have been made prior to 1/4/2017, you would get regular income of the investment made prior to 1/4/2017, that is not grandfather. Only the income from transfer of investment made prior to 1/4/2017 is grandfather. So with this background, now take the current situation on hand. You had acquired shares prior to 1/4/2017 in a company, which will then become subject to a tax neutral merger or demerger. Post that, you would have the shares allotted to you by the amalgamated company or the resulting company. And those shares that would come to you post 1/4/2017 on the strength of the shares acquired by you in the predecessor company, which you acquired prior to 1/4/2017, you get shares of the amalgamated company or the resulting company. Now you would transfer those shares. Would you get the benefit of grandfathering? If you would look at Rule 10U14 carefully, it would grandfather income from transfer of investment. So that would be critical for you to understand what is the meaning of investment. When you secure certain money into a particular mode, so that would start fetching you some return, that would be called as investment. Now, when did you invest? You invested in the shares of the demerging company or the amalgamated company. When, as a result of demerger or amalgamation as operation of law, you would get certain other shares in lieu of the existing shares. That would not mean that you invested again. See, the whole objective is to ensure that the money which you have invested prior to introduction of GAR should not take you by surprise thanks to introduction of GAR. The language used is investment, and you stood invested. Just that your form of investment may have undergone a change. So mere change in form of investment should not deny you the benefit. And accordingly, my answer is that the benefit of grandfathering would be available even to the shares of resulting company or the amalgamated company, which have acquired as a result of your having held shares in the demerged company or the amalgamated company. You also can take support from various tax neutral provisions Like you have section 47(7), you have 47(6)(d), you have 49(2), 49(2)(c), 49(2)(d). You will have section 242(a), which will deal with, the period of holding, explanation 1c and explanation 1g. All these sections read together would convey that these transactions will have to be regarded as tax-neutral transaction. As a result of switchover, there should not be any incidence of tax. And eventually, your investment is considered as your original investment. Your cost of acquisition of those shares alone will be deemed to be cost of acquisition of the new shares. Considering all this, considering the language adopted, I'm sure the next question, the answer will have to be slightly different. Considering the language adopted insofar as section, so far as this particular rule 10U14 is concerned, you should get the benefit of grandfathering.
Thank you, sir. Would your answer be different if somebody acquired compulsorily convertible preference shares before April 1, 2017, and those shares were converted to equity shares after such date, or would the grandfathering apply even to such converted shares?
The Indo-Singapore Treaty, right? Yes. Yeah. So now, as I had guessed, the next question would be a slightly challenging question, because my answer to the earlier question is on the basis of language used in Rule 10U, because the language used is investment. Abhishek now shoots another question. This is in the context of Indo-Singapore Treaty. If you would recall, the first protocol of 2005 amended Article 13 of the Indo-Singapore Treaty to provide residence-based taxation in respect of various alienations. That means capital gains, except in some stray cases, like the ship, aircraft, immovable property, permanent establishment. Barring these, the rest of the cases, you have to pay tax not in the source country, you have to pay tax only in the residence country. This is the first protocol, 2005. Of course, it came with some, limitation of benefit, so that you wouldn't get the benefit of this special treatment for a shell company or a conduit company. They brought in various conditions like your annual expenditure will have to be not less than 2 lakh Sing dollars or 50 lakh of rupees, or your shares will have to be listed, all that. Subsequently comes third protocol in 2011, where subarticle 4 of Article 13 is substituted by 4A, 4B, 4C, and 5, whereby they brought in grandfathering. This grandfathering is not similar to GAR grandfathering. This grandfathering is grandfathering of the very exemption itself. In the case of GAR, they would want to grandfather when you get into impermissible avoidance arrangement. This grandfathering, what you have in Indo-Singapore Treaty, is not in that context. It is just that there is some benefit which has been available all along. They would want to stop with the grandfathering. If you would look at subarticle 4A, the language used is gains from alienation, gains from transfer of shares acquired before 1/4/2017 would get grandfather. Now the question here is, you had acquired compulsory convertible preference shares prior to the grandfathering date. Because it is compulsorily convertible, it is inevitable that it will become equity shares. So post 1/4/2017, what you hold in hand is equity share that you obviously acquired after 1/4/2017. You can see the fine distinction in the language. In 10U, the language is investment. Here, share acquired. It cannot be said that you acquired the equity shares prior to 1/4/2017. You acquired them only thereafter. So therefore, on a highly technical reading, one may want to argue that you would not get the benefit of grandfathering. But then, as I've said earlier, if you would look at various tax-neutral provisions, even conversion of preference shares into equity share is also considered tax-neutral. You will have provisions made in Section 47, you will have provisions made in 49, you will have provisions made in 242A. More importantly, there is one press release dated 23/3 of 2017 in the context of a third protocol amendment to the Singapore Treaty, where they use the language as grandfathering of investment. So therefore, even if the language used is share acquired, the purpose and intent is to grandfather the investment, so that the investors are not taken in by surprise. So Abhishek's question is fairly simple. Like convertible preference share would become equity share. Take the case of convertible debenture, compulsorily convertible debenture, which was never ever a share. That becomes share post 1/4/2017. Then also, going by the letter and rather intent of it, because treaty should not be read as act. So there is a difference between reading the act and reading the treaty. Treaty, according to Vienna Convention, will have to be read in good faith. It is an agreement. It is not a piece of statute. If it were a piece of statute, you would go by literal interpretation. Know what to be added, know what to be subtracted. We are now interpreting an agreement. It has a purpose behind it. If you keep in mind the purpose behind it, you have to make a purposive interpretation and not a strict interpretation. On this premise, I would continue my view that even in respect of converted equity shares, you should get the benefit of grandfathering in the Indo-Singapore DTAA.
Thank you, sir. Padam sir, I'll move to you to more nuts and bolts questions around partnership firms, which I'm sure a lot of the members in the audience are running themselves. Two questions, sir. One, if you could kindly share your views on the recent Supreme Court decision in Mansukh dying. And secondly, if you could summarize for the benefit of the audience, also in light of this judgment, what is the import of the recent amendments to Section 45(4) and the introduction of Section 9B?
Before I begin answering, thanks to the organizers for inviting us this afternoon today and participate with all of you here and share our thoughts on certain important developments that have happened in the regime of taxation. The heading for this conference talks about order and chaos. It's not saying order from chaos. It says order and chaos. It's a situation where you're going to be perpetually facing the battle of some difficulty that is visiting us in the course of our everyday practice. And the question that Abhishek is asking is one such instance where we have had a decision of the Supreme Court unsettling, upsetting the normal thought process we have had. And therefore it becomes important because partnership is a very natural consequence. We find partnership across the country the most common medium of organizing people into a business venture. And we therefore have situations of admissions, retirements, dissolution of partnership firms, and naturally the question arises as to the tax consequences attaching these events concerned. The case of Mansukh dying is a case where there were certain reconstitutions done in the partnership firm. First time reconstitution happened because of a family settlement that happened when one partner's share got reduced. Somebody else from his family became partners. Before the second admission happened, there was a revaluation done. And that revaluation, therefore, was credited to the partner's account post the admission of the partner. The fellows who came in now, the new partners, brought in small amounts of capital. After they were admitted to the partnership firm, significant revaluation was made of land and buildings, and credit was given to the respective partner's capital account, technically permitting them to withdraw at their convenience the amount that has gone to the credit of the capital account represented by the revaluation. The AO said this is taxable as income because effectively the monies have been credited to the partner's capital account, giving them the ability to draw these monies out. And the AO therefore said, and confirmed by the CA.P. appeals, that to the extent there is a credit to the partner's capital account, there is a relinquishment by the partner in favor of the firm, enabling the partners concerned to draw this money out, and that credit itself is a relinquishment, and to that extent there is a transfer. Therefore, he said this is taxable. The AO said this is also taxable as short-term capital gains because this was represented by a revaluation of building, which is covered by Section 50 because depreciation had been claimed on this. This is one facet of this transaction and the tax implication. But what's important for us to go back to the entire gamut of facts, and that is available when you read the High Court decision. You may not get these facts in the Supreme Court decision. Revaluation was done in year 1, that is 93-94 assessment year. In the assessment year 94-95, this firm got converted to a company by the process known erstwhile under Chapter 9 of the Companies Act. So it got transformed into a company. In that year, assessing officer said, there is a transfer by the firm to the company. He levied a tax all over again, saying, hey, this is a case where the firm has transferred the assets to a company concerned. Therefore, he says, I'm going to levy a tax. He levied a tax. Both the matters went in appeal. 93-94, a revaluation matter went in appeal. 94-95, next year, when the company became a firm, when the partnership firm became a company, the matter again was taken in appeal because the AO said there's a taxable event all over again. Possibly the AO wanted to protect himself to say, if I lose the battle in 93-94, I'll possibly have some chance of success in 94-95. He therefore said, there is a conversion, and therefore this is a taxable event, I'm going to levy a tax. When the matter reached Supreme Court, both the appeals went to Supreme Court. The High Court had decided the matter in favor of the SSC, saying no, on revaluation, no tax, for the reason that by virtue of the Supreme Court decision in Hind Industries case, they say, Hind Construction case, revaluation does not give rise to a taxable event, not taxable. Second year, when they said there is a conversion of a firm to a company, relying on Rita Mechanical Engineering, relying on Techspin's case, the High Court said not taxable again. When the matter reached Supreme Court ultimately said both the appeals of the revenue are allowed, and therefore in both the years the SSC loses the appeal, the department wins the appeal. Interestingly, this is a very interesting aspect of the Supreme Court that we have to be mindful of. Therefore, Supreme Court said both the revenues appeal are allowed. For 93-94, revenues appeal is allowed. 94-95, revenues appeal is allowed. And there is no abatement for the tax suffered in the first year. If you go literally by the Supreme Court decision, it appears to be therefore that the partnership firm will suffer tax both in year 1 when there is a revaluation because there is a relinquishment, and in year 2 because there is a conversion of the firm into a company. This possibly, in my opinion, is an extremely unfortunate consequence of the entire process, but nevertheless, this gives us some thought process for us to go into the ramifications of the decision concerned. What will be a remedy available for the SSC, I will not discuss for the time being. That will be a course where they will go back to the Supreme Court, ask for a review petition, go about. For the time being, I don't think there's a consequence for us to be concerned in this discussion today. What's important for us to understand is the law attaching the relationship between a firm and a partner. That becomes very critical for us. And we therefore have to understand this in 3 different time zones. One is prior to 1987. One is post-87 to 2021. Because in this period, we have 45.3 being introduced, we had 45.4 being introduced, simultaneous with the exclusion or omission of 47 subclause 2. So this is the period from 1987 to 2021. And from 2021 onwards, as Abhishek said, 45.4 has been substituted, 9 capital B has been introduced, and therefore there is a law that we have to understand vis-a-vis the amendments made by Finance Act 2021. Now, prior to 87, what did the Supreme Court decisions talk about? Let us go back to a number of decisions. Bankilal Vedia's case, Malabar Fisheries case, number of cases are there which have dealt with the relationship between the firm and the partners. And Supreme Court said in all these decisions concerned that the partners own the assets of the firm, although they may not have any specified interest in that firm's property, but they are, as a conglomerate whole, the owners of the property, such that when the property moves away from the firm into the fold of the partners, it's a mutual adjustment of the rights of the partners over the asset. They were the owner of the asset even earlier. They are now therefore having a crystallization of the interest concerned, and therefore they said this is not a taxable event because the partners themselves were owning the assets prior to that movement of the assets from the firm to the partner. In this process, they relied upon the civil law consequences, where under the civil law, a firm is not a legal entity, and therefore it is some sort of a compendious name for the partners having joined together to conduct a business. Therefore, by virtue of the civil law consequences being imported, Supreme Court consistently came to the conclusion, even in Mohan by Pamba's case, saying that there is some sort of a pre-existing ownership rights of the partners concerned. Therefore, the movement of an asset from the firm to the partners should not give rise to a taxable event because it's an adjustment mutually between the partners itself. To get over this, they brought changes to the law. 45(4) was introduced to say, we would like to change the process of this understanding concern, and we would like to therefore say that where there is a transfer of an asset on dissolution or otherwise, then the firm will pay tax on the market value of the property that is moved from the firm to the partners. And they, at the same time, omitted 47 subclause 2, which gave an exemption on the distribution of assets on the dissolution of a firm. This was transaction not regarded as a transfer. That was omitted from the statute book. Therefore, on a combination of these two sections concerned, the board through its circular 495 said that if there is a movement of a capital asset from the firm to the partner, this movement can happen at the time of dissolution or can happen at any point of time. Maybe on retirement, maybe without retirement. That's why the word otherwise was used. Whenever there is a movement of an asset from the firm to the partner concerned, that should give rise to a taxable event. The fair market value of the asset on the date of that movement concerned should be regarded as full value of consideration, and capital gains shall be accordingly charged to tax in the hands of the firm. Because of this movement in law, when the matter traveled to A. Naik's case in a subsequent year, looking into the intent, looking into the philosophy, looking into the mindset of changing the law itself, Bombay High Court said, when there is a movement of an asset from the firm to the partners concerned, that has to be regarded as a taxable event. It could be at the time of dissolution, or it could be at any point of time when the asset moves over. But reiterating what was mentioned in the board circular 495, the Bombay High Court reiterated that there has to be a movement of the asset from the firm to the partner. If that were to happen, then there is a case of tax being attracted under 47(4), and that was a case where the asset had in fact moved consequent to a family settlement from the firm to the partners concerned. So in those circumstances, the Bombay High Court said this is taxable event. When the matter went to the Supreme Court in the case of Mansukh dying, Supreme Court has said we entirely agree with the ratio laid down by the Bombay High Court decision. So to that extent, therefore, when there is a movement of an asset from the firm to the partner, fine. There is, by virtue of the philosophy, change in the mindset by 495 circular, this has to be regarded as a taxable event. But when the Supreme Court went on to observe the conditions of revaluation and a credit to the partner's capital account, and whether a mere revaluation results in a taxable event, Supreme Court, in my opinion, a little unfortunately, came to a conclusion that a revaluation of an asset and a credit to the partner's capital account, that accounting entry by itself is tantamounting to a distribution of the asset in favor of the partner to the extent of the revaluation. Now, this is, in my opinion, a far-fetched understanding of what should happen when I am therefore passing an accounting entry. The asset is valued in the firm, is shown in the books at 100 rupees. I am revaluing it to the extent of 250 rupees. The differential 150 rupees I am crediting the partner's capital account. Supreme Court is making a proposition that this credit of 150 rupees, which is representative of the revaluation done, shall be regarded as, or shall be tantamounting to, or shall be equal to the distribution of the asset from the firm to the partners, and therefore it's a taxable event. Quite a few questions will arise therefore. Now, if you were to make this statement, this gives rise to a lot of unintended consequences. To the extent of 100 rupees, technically by going by the Supreme Court decision, there is no transfer. To the extent of 150 rupees revaluation, there is a distribution. So the question therefore arises, is the asset now being owned by two entities concerned? To the extent of 100 rupees, is it owned by the partner? To the extent of 150 rupees, is there a relinquishment? Is there a movement into the partner's hands? Are you going to therefore talk about that type of a proportionate ownership? If there were to be rentals achieved by the firm from that property concerned, are you going to say there are two owners concerned? What happens if this property asset is sold tomorrow in favor of somebody else? Let us say for 600 rupees. Are you going to then make a statement that the firm has transferred, the partner has transferred, both shall pay capital gains tax? These are consequences that the Supreme Court has not fathomed. And therefore, mere statement, a bland statement, one paragraph there to say that the revaluation accounting entry shall be equivalent to a distribution. This statement, in my opinion, goes contra to the Supreme Court decisions earlier, which says that a mere accounting entry does not give rise to a taxable event. Surji Vallabhdas case, there are a number of decisions concerned to say a mere accounting entry, therefore I pass a asset debit partner's capital account credit. That's a mere accounting entry. A mere accounting entry should not give rise to any taxable event. And therefore, a situation where Supreme Court is now making a statement that this accounting entry shall be tantamounting to a distribution of the capital asset to the partners concerned is stretching the law too much. Because when it says we are endorsing the Bombay High Court decision in Nayak's case, and we are saying there's a change in law, and looking at the change in law, we are asking for a changed approach to the issue of the firm and the partners taxation. What the Supreme Court, in my opinion, forgot was the fact that the board circular, the Bombay High Court decision, the memorandum explaining the provisions of the finance bill, all spoke about movement of a capital asset from the firm to the partner for it to be regarded as a taxable event. In this case of a revaluation, there is no movement of the asset from the firm to the partners, and therefore, to make a statement that it is in tune with the changed intention of law is possibly stretching the law too much. Therefore, in my personal opinion, the Supreme Court has gone a little astray in understanding the correct implications of law. Now, what is the consequence? What is the remedy to that? Do you have a remedy to that? We made a statement that possibly the assessor will have to go in some sort of a review petition, not for the purpose of change in the law, but for the double consequences. Therefore, for the purpose of change in law or for the purpose of attacking the Supreme Court on this law, do they have a remedy available? Interestingly, if you look into the February 2023 issue of the Bombay Chartered Accountants Journal, there is an article written there where there is a reference to 4 SLPs before the Supreme Court. 4 SLPs. One of the SLP was A. in Naik's case, one more from the Bombay High Court, 2 from Karnataka High Court, in Suvardhan's case and one Davangere Musalappa's case. 4 SLPs went to the Supreme Court. These Supreme Court SLPs were before a 3-member bench. Now, before the SLPs could be decided, 2 Bombay High Court persons concerned, A. in Naik's case and one more Ravina Trader's case, they withdrew this special petition. 2 remained. These SLPs were converted to civil appeals, and the civil appeals where the revenue had come to the Supreme Court were dismissed by the Supreme Court. Now, when a SLP is converted to a civil appeal and the appeals are dismissed, it is in effect a pronouncement by the Supreme Court. Whether it carries reason, it does not carry reason. By virtue of the Supreme Court decision in Kunya Muhammad's case, this becomes a binding precedent. And therefore, when there is a binding precedent of this nature, by 3-member bench, one could possibly make an argument now to say that this decision of the 2-member bench, not having considered the 3-member bench, not having therefore gone into that law concern, is possibly not necessarily to be binding. That's a matter that the councils and assessees will have to argue. But what's important for us to be aware of is the fact that by virtue of the article presented in Bombay Chartered Accountants, we should be aware of and mindful of the fact that there are 2 SLPs converting to a civil appeal dismissed, that is the revenue appeal dismissed by a 3-member bench. And that becomes a little more stronger for us to urge tomorrow. Now, this is the way in which the Supreme Court has gone about, in my opinion, not a very correct expounding of the law concern. But rightly or wrongly, what Abhishek is asking is there some relief available to us because there is a change in the law? 45(4) has been substituted, 9 capital B has been added. Therefore, is there a change in law? When you look into 45 subsection 4 as substituted now, we don't have the word transfer, we don't have the word distribution. Therefore, the Supreme Court statement that revaluation shall tantamount to a distribution may not necessarily be now relevant under 45(4) as coming from Finance Act 2021 because the word distribution is not used there. What does 45(4) talk about? It says, when a partner receives money or a capital asset in connection with the reconstitution, then the fair market value or the cash received by the partner shall enter into a computation where A is equal to B plus C minus D. A computation is given to us. Now, what's important for us is that the partner has to receive cash, the partner has to receive a capital asset. Only then it will translate to some sort of a transfer by the firm, and therefore there could be a tax implication in the hands of the firm concerned. So a mere tantamounting to relinquishment, a mere deemed distribution does not translate, in my opinion, to a receipt by a partner. That may be a transfer by the firm, but the law is not talking at the transfer by the firm concerned. The law is talking about a little more positive scenario of a receipt by a partner. And till the time the receipt by a partner does not happen, you have to make a statement that 45.4 is not attracted. So one way of addressing things would be that in the change setting of 45.4 today, when they're talking about a receipt by a partner, the word transfer is not used, the word distribution is not used. We can make a statement, therefore, that there could be some relief available to the assessee concerned because of the mandate of 45 subsection 4. And what happens, therefore, is there, along with the capital asset, if you're having stock in trade and you're revaluing stock in trade also, what will happen to the revaluation of stock in trade? 45.4 deals with only capital asset. Stock in trade is not covered. What happens to stock in trade? You have to go to business income. When you go to business income, what does it say? If you're revaluing stock, is there an income that is chargeable to tax in the hands of the firm because of a mere reevaluation of stock? Supreme Court Chain Group Sampatram's case says that mere revaluation of stock does not give rise to a taxable event. Therefore, Supreme Court decision should hold good for the assessee concerned that this incident of revaluation of stock shall not give rise to a taxable event. Go back to 9 capital B, which talks about receipt of a stock in trade or receipt of a capital asset by a partner from the firm to trigger 9B on either reconstitution or on dissolution. Again, the taxable event for 9B is a receipt by a partner of a capital asset or stock in trade. As long as you are able to make a statement that there is no receipt by a partner concerned, then 9B shall not be attracted, and that's possibly a defense for us to say that 9B and 45.4 in the changed setting shall not therefore trouble the firms concerned and the partners concerned by the application of the Supreme Court decision in Mansukh Daing's case.
Thank you very much, sir. It's a travesty that sitting so close to you, I can't follow most of what you said. I would have loved to hear the great discourse you gave on such a vexed topic. Sir, I think we're running a little short of time. I'll just come back to you for a very brief response on section 56 in the context of 56(2)(10), whether the section should apply for a fresh issue of shares. So if a company issues fresh shares to a shareholder, whether again the test of fair valuation needs to be done to determine whether there is any income under section 56(2) subsection 10.
56(2)(10), the expression used is any person receives from any other person. The expression used is receive. So whether a property is received is the one which has to be tested. The taxable event is receipt of property. It is slightly silent whether there should be a transfer at all. Whether the property should have existed before it is received at the hands of the transferor so that it can be received by the transferee, that is the allottee here. That's the question which you are possibly raising. Since the section is silent on transfer, one will have to possibly infer that the pre-existence of the share before receipt is not a requirement under the law at this point in time. And the share gets created only upon allotment and receipt in the hands of the shareholder. So he has received the share. So as far as the property is concerned, it has got created in the hands of the recipient, and its fair value is less than, more than the value he has paid for the shares, and therefore there is an income, can be the technical interpretation. I think it falls today. So I will be very guarded to say that fresh issue of shares at less than fair market value can be a matter of concern, and it may result in a taxable event, the way the law is positioned currently. I may also say company law also mandates that fresh issue of shares, except in certain circumstances, shall be at fair value. So there is a dual requirement that the company law also requires that it shall be at fair value. Income Tax Act also says that if it is less than fair value, it will be liable to income tax. It will be treated as income in the hands of the recipient. I will say fresh issue of shares at less than fair value is at risk, and it may be subject to tax. The pre-existence requirement of the property is not straight away coming out of the section is my.
Thank you, sir. So Chythanya, I'll just continue with the same section, but a very different fact pattern. You know, if Mr. A, for example, gifts certain shares of an Indian company to Mr. B, and the section 56.210 creates a tax incidence on the recipient of the gift. Here there is no debate that the property existed or not, because there is an existing share being gifted from one person to another person. The recipient is paying the tax based on the 11 UA value, Rule 11 UA value. However, when it comes to a gift transaction, the fundamental provisions also provide that the recipient of the gift will be deemed to be holding the gifted asset from the period the original person held it, as well as the cost of acquisition shall be the cost of acquisition to the previous owner. But having paid tax under 56.210, there is also a provision that says that the value on which such tax was paid becomes the cost of acquisition. So the question for you, sir, is that in the hands of the recipient of the gift, what will be the cost of acquisition? And will the fact that he has paid tax under 56.210 in any manner vitiate his claim that the period of holding goes back to the previous owner?
Before I would answer, I just have to add on what PVS said. For attracting 56.210, the requirement is that you will have to receive from another person the property. Now, when the shares are allotted to you, do you receive shares or do you get shares? Is receipt not the corollary of somebody giving? If you would look at the decision of Supreme Court in the context of gift tax, Code's case, the Supreme Court went on to say that you couldn't be said to have received the shares in the case of fresh allotment of shares. I would give you a parallel example. Somebody leaves a property behind through a will, and upon his demise, the property comes to you. Could it be said that you received from a non-existing person? At the time of receipt, he is not there. So these are the situations not envisaged in 56.210. So therefore, while not disputing what PVS has said, just the other view is that in order that you receive certain thing, there has to be somebody who gives that certain thing to you. And in the case of fresh allotment of shares, the company as such wouldn't hold the shares to give it to you for you to receive it as shares. It's one just about a thought. Of course, it's a different matter that A Limited holds shares in B Limited and gives away those shares to you. In which case, of course, it can give away the shares which it holds in certain other company. Then surely 56.210 will get attracted. Not when, of course, just another thought process, not when the shares are created in your hands for the first ever time. They come into existence on your hands. And therefore, it can't be said to be received is another way of looking at it. With this, now let's look at a situation where you get gift of certain shares. When you get gift of certain shares, I'm assuming 56.210 is attracted. You don't get it from a relative, so you pay tax. And as soon as you pay tax, when you get these shares as gift on the basis of 11 UA valuation, the value so adopted would become your cost in terms of 49.4. There is no difficulty on this because you would have paid tax on the fair market value, and not to accept it as cost later on to treat the cost to the previous owner would then, mean essentially taxing it twice over, for which reason they'll give you the benefit of some sort of stepped up cost in section 49.4, whereby whatever was the fair market value adopted for taxing you under 56.210 would be treated as a cost of acquisition. Having said that, the question is, what is the period of holding? Now, when you get something absolutely as gift, without any consideration, you would get covered by two situations in section 49. One is in 49.1, where you get it by way of gift. 49.1 covers it, where the cost to the previous owner would be a cost. So all gifts generally come under 49.1. But certain gifts which are not exempt, which are chargeable to tax under 56.210 would get covered under 49.4. I'll give an example. You get a gift of shares from your spouse, covered by proviso, exempt, 49.4 would not apply, 49.1 would apply. So cost to the spouse, the cost to you. Now get it from non-relative. Get it under circumstances where it wouldn't be exempt under 56.210, but nonetheless as a gift. It's a special case covered under 49.4. You have this principle of generalia specialibus non-derogant. This is a very special provision dealing with a situation where you are taxed under 56.210. So therefore 49.4 will prevail over 49.1 insofar as cost of acquisition is concerned. With this background, let's go to the period of holding. If you go to the period of holding, you will have section 2 within brackets 42 capital A. Explanation clause B. Explanation clause B says, where you would acquire a capital asset under circumstances described in section 49.1. You have got it as a gift. It's a different matter that you would have paid tax under 56.210, but is it not still a circumstance described in 49.1? The answer has to be in the affirmative. You have received it in the circumstance described in 49.1, and there is no such circumstance described in 49.4. 49.4 never says gift or whatever. It is a situation, not a circumstance. It's a situation where you have been made to pay tax under 56.210. It's not a circumstance. Gift is a circumstance. So that is described in 49.1. Therefore, it wouldn't be too bad an idea to suggest that your case, despite getting covered under 49.4 insofar as cost of acquisition is concerned, insofar as period of holding is concerned, there is no other conflicting clause in explanation to section 242 capital A. So your case would very well fit into the circumstance of gift which is described in 49.1, and hence the period of holding by the previous owner will also have to be reckoned for determining the period of your holding. This will give rise to further interesting questions. Fine. Insofar as cost is concerned, I would go by 49.4. Insofar as period is concerned, I'll go by 242A, explanation 1B, which makes a reference to 49.1. Would I get the benefit of indexation? So applying Manjula Shah's principle, which was delivered in the context when we never had 56.210, in Manjula Shah, Bombay High Court, when the matter went to Supreme Court, the matter was, SLP was dismissed on the basis of monetary limit. So the Bombay High Court held that the benefit of indexation should be available from the time when the previous owner held it. And subsequently, almost all the high courts across the country invariably followed Manjula Shah's principle. But this was given at the time when we didn't have 49.4. Now that the 49.4 would take the fair market value at the time of you having to pay tax on gift under 56.210, which would have covered all the inflation up to that point in time, should you be getting the benefit of indexation in respect thereof? There are two ways of answering it. One is you have to get the benefit of indexation. As long as it's long term, you should get the benefit of indexation. Objective of indexation is to substitute your cost by indexed cost. Now the cost is given under 49.4 as the fair market value adopted under 11 UA. Henceforth, you take that as your investment. That point in time when valuation is done will have to be starting point. Take the inflation index at that point in time. Take the inflation index at the point in time when you eventually transfer the shares, and then apply the benefit of indexation. There is no statutory bar here. If there is any confusion on this, it is more a charging provision, not an exemption provision, and hence the view that is favorable to taxpayer will have to be adopted. Therefore, it is not too bad a proposition to suggest that, insofar as to summarize, cost of acquisition go by 49.4, period of holding go by 242, explanation 1B read with 49.1, and reckon the period of holding by the previous owner. When it comes to indexation, apply the benefit of indexation, but may not be from the time when the previous owner acquired it, from the time when the FM is adopted in your hands till the date of alienation of shares by you. May not be very bad idea to adopt this.
Thank you, sir. Padam sir, one last question for you before we open up to the audience. I'll keep the question brief. Basically, can the same transaction of issuing shares at a very high premium be brought to tax both under section 5627B and also under section 68?
The question is, there is a person who has subscribed to the share capital of a company. The share is subscribed at 1,000 rupees in the example we could discuss about. The fair market value of that share is, let us say, 100 rupees by virtue of Rule 11 UA. There is a differential of 900 rupees which is representative of unjustified premium. Under the law, under 5627B, this is required to be charged to tax. But what Abhishek is asking is, that person who subscribed to my share capital of 1,000 rupees per share, his identity or his capacity is not proved by me, or the genuineness of the transaction is not proved by me, the conditions of section 68 are attracted, as a result of which, therefore, the income is, or the amount subscribed to by the individual concerned to the entire extent of 1,000 rupees is liable to be charged to tax under section 68. Therefore, the question is, can there be a double taxation both under 68 as well as 5627B? The answer to that should be no, because unless there is an explicit provision for double taxation, 77 ITR 107 Supreme Court says there shall not be a double taxation. For example, we have today under the statute a double taxation under 45(4) as well as 9B, conscious application, saying that under both the provisions you shall be paying tax. I shall give you an abatement, I shall give you some sort of a relief tomorrow, but as far as the present law is concerned, present state of affairs is concerned, you shall be liable to pay tax both under 45(4) as also 9B. There has to be an explicit provision of this nature mandating double taxation. Then yes, you can make a statement that there shall be a double taxation. Otherwise, there shall be a case where you are going to avoid double taxation. The question therefore is, if you are trying to avoid double taxation, then would there be some sort of a clash? Are you going to make a statement that I apply 5627B first or apply section 68 first? What is the hierarchy? What is the hierarchy? What section do you apply first? 1. 2. Is there some sort of a conflict between 5627B and section 68? To answer this question, we'll have to go back to the proviso to section 68, which says, if there is a subscription by somebody to the share application money, to the share capital money, to the share premium money, then the conditions of 68, that there has to be an explanation of the source by the person concerned who subscribed to the share capital, identity, capacity, genuineness, source of source will have to be proved. Only then AO can say you passed the test of section 68. This proviso came into effect by the Finance Act 2012 from 1/4/2013. The same Finance Act brought in 5627B into the statute to say where there is a issue of a share beyond the face value, and to the extent that it is going beyond the market value also, the extra or unjustified premium can be chargeable to tax under 5627B. So to the extent, therefore, these provisions were brought by the same Finance Act, the legislature are very conscious about these two provisions concerned, and inherently, therefore, in their perception, there is no conflict. In my opinion also, there shall not be regarded as a conflict between these two provisions concerned. The only issue, therefore, arises of the hierarchy. Which should you apply first? Because 5627B is talking about valuation exercise. You are going to look at the amount received, look at a valuation. If it goes beyond the valuation, the extra amount beyond valuation is taxable. There's no question of identity, genuineness, and all of this creditworthiness of the party concerned under 5627B. That happens under 68. 68 looks into these characteristics or list factors concerned, but does not concern itself with valuation. They doesn't look at valuation at all. They only say identity, capacity, genuineness. If you prove, 68 will not apply to you. So you look into the hierarchy of tests, identity, capacity, genuineness, and then go to 5627, we look at valuation concern. If you look into the importance of this respective test to be laid down, in my opinion, you have to evaluate the whole transaction under section 68 first. If you are able to therefore pass the test of identity, capacity and genuineness being proved, then you go into section 5627B. If you fail the test, then what does it mean? That this is going to be an income chargeable to tax under section 68. Under what premise? On the premise that it is your own money that has come back to you. Therefore, the person who has helped you, he is an accommodating party. He has only therefore helped you siphon off your own money or bring back your own money back into the circle by being an accommodating party or a person who helps you out on this matter. Your own income is therefore brought to tax under section 68. If that is your own money brought to tax under section 68, the question of then applying the valuation mechanism, because it is your own money. 5627B says, where you receive consideration for issue of shares. There's no consideration received because consideration has to flow from a new person, third person concerned. When it is your own money, there can't be a question of receipt of consideration by the company concerned, and 5627B therefore should not be attracted at all at the threshold, having suffered taxation under section 68. So if you are able to therefore demonstrate, or you are not able to demonstrate the identity, capacity and genuineness, 68 is going to be attracted and the income shall suffer tax, the whole of the income concerned. 5627B only talks about what? It talks about any amount beyond the face value. So between 5627B and 68, you are going to make a statement. If the AO were to proceed to 5627B and say, I am going to tax you under 5627B on unjustified premium, then what you can make a statement is, you have examined this, you have examined therefore the identity capacity are deemed to have been satisfied, you are going to tax me on the extent of 900 rupees. To the extent of 100 rupees, there is an exemption available to you because up to the extent of face value, you can't get taxed under section 5627B. And this protection, in my opinion, shall survive for 68 also. To the extent of this 100 rupees, AO should be precluded from paying tax under section 68. The hierarchy between 68 and 5627B has been discussed very well by the Kerala High Court decision, where you can find out the good discussion on this matter. And the Kerala High Court, in my opinion, correctly presents the position concerned that 68 shall present itself. 68 is what? It's a rule of evidence. It's a case where you are having undisclosed income. This undisclosed income can be from a disclosed source, can be from an undisclosed source. When having undisclosed income from a disclosed source, we go back to the respective heads of income for being charged to tax. When having undisclosed income from an undisclosed source, 68, 69 will lead to an evidence, and possibly that may be an income chargeable to tax under income from other sources. It's a source concept. It's a question, therefore, of the difficulty, the dilemma regarding a source, the rule of evidence, and those rules of evidence are laid down by 68 and 69. I'm aware of the Kerala High Court decision. I'm aware of the Gujarat High Court decision where they say 68, 69 are a headless income. They don't come into section 14. But there are also contrary decisions on this matter. If you were to understand the 68 is a rule of evidence, then possibly you can make a statement that you will have to ask this question concerned. Is this a rule of evidence to understand undisclosed income from what type of a source? Disclosed source or from undisclosed source? Depending on that classification, we will have to make an appropriate classification of income under section 14 of the Income Tax Act.
Thank you, sir. I think we've exceeded our time. Maybe we'll just take... Sorry, sir.
One clarification, thanks to Mr. Chythanya. Whether the question is under 139(8)(a), when a foreign company files a return, the updated return, whether prosecution would lie. I gave that prosecution would not lie based on interpretation of law, but there's an express provision under 276(c), which clearly says that there shall not be prosecution initiated for failure to file a return once you file a return under 139(8)(a). So since there's an express provision, we don't have to go for any interpretation of the law.
Yeah, I think we'll just take 2 questions from the audience, if any. So if anybody wants to ask the panelist on any of the topics we have covered or anything else, please keep your question brief.
Sir.
And in the interest of time, we will take 2 questions.
Sir, please throw the light on amendment to section 43B in the budget, please. Regarding amendment, payments to small and micro enterprises. Please throw a light.
43B, payments to MSME before filing the due date. So, the government is looking at MSME sector at a larger policy level. one of the suggestions is that come up with a paper which will support them universally, take all policy decisions together and make a recommendation. One of the recommendations is that encourage payment within a certain time frame so that there is no deduction available to the payer unless it is paid within a due date for filing the return. So this was a recommendation made to the Ministry of considering the MSME sector as a whole. More proposals are being considered. They will all be in the field of financing, ability to get loans, ability to have collaterals, etc. This is only in respect of payments to encourage payments. I think it's a very restricted application. It would mean that we need to track our payments to MSMEs and also make a payment to them before filing the date. We also have to keep the GST law also in mind that within 6 months we have to make a payment to the vendor. That also needs to be looked at. So I think the laws are all flowing towards payment within a due date. That's it.
Sir, what is the intention of the law? Because if we don't pay within the due date, we have to pay the tax and we have to pay to the supplier too later.
The intention is not to allow a deduction to a company which has procured from MSME unless a payment is made before the due date for filing the return.
Okay, sir. And later I have to pay to the supplier too?
Whenever you pay, you will get it. It's not that it's permanently lost.
It's an advance tax, 234B and C, its effect?
That's why, if you have not paid before filing that, see, 234B, C, etc. gets visited, C gets visited before the end of the financial year. You have got till filing the return to make a payment to the MSA. So it's essentially a planning that you make your payments before filing the return. It is to protect the MSME, nothing more.
Thank you, sir. Last question, anybody else? Well, on that note, I would just like to thank the KSCAA for having us on this panel. The topics were very, very interesting. I wish we had more time. We could have gotten over many other very interesting and vexed issues. But I must thank each of our illustrious panelists, Padam sir, Chythanya sir, PVS sir. Thank you for your enriching thoughts. Thank you, everybody.
Thank you, sirs. It was indeed amazing to listen to all the stalwarts of direct tax on various issues like updated return, GAR, partnership firms and so on. It is always more helpful to understand provisions through case laws, and hearing your opinion on such case laws has given us a more in-depth understanding of the provisions.
I request CA Chandan Hegde to present a memento to CA Abhishek Goenka, who moderated the session wonderfully well. I request all the delegates to join your hands together for this elaborated session on